Hi, this is Sarah from In Accountancy, and today we are going to look at how you actually go about calculating the capital gains tax on the sale of a property in order for you to understand whether you need to complete and submit a UK property return and how much tax you're going to have to pay. So just to recap, in our last video, and I'll pop a link in the comments here so you can access that quickly if you haven't listened to that already. But in our last video, we looked at who has to file a UK property return, when that needs to be done, which is within 60 days of the completion of the sale of the property, and how you go about doing that via HMRC's online digital account. And today we're going to look at how you actually calculate the gain that you will make on the sale of this property. First of all, you need to prepare a tax computation. And essentially what you do is you look at the proceeds from the sale and you have a number of expenses, I suppose, for want of a better word, that you can take off those proceeds to come up with your overall capital gain on which then you calculate the tax. So you've got the proceeds from the sale, and first and foremost you take off the acquisition cost of the property. Then you can also take off other costs associated with either the disposal or the acquisition of that property. So these are capital costs, and we'll do another video shortly which will explain the difference between capital costs and repairs and other expenditure on property. But capital costs in this instance are most likely to be stamp duty, land tax, land registry fees, and of course your legal fees on sale or acquisition of the property. So you can take all of those off. You take off your annual capital gains exemption, which used to be £12,300 per person per year, reduced in 23-24 to £6,000 per person per year, and was reduced further from the 6th of April 2024 to £3,000 per annum per person. So you can take off your annual capital gains exemption. You take off any other reliefs that you might have. So for example, if there's mixed usage, you can take that off. If you lived in the property for a certain length of time, you get what's called private residence relief that you can take off. And you may also have some losses, so capital losses in the year, or even capital losses that you can bring forward and take off that cost. And that will give you a net capital gain. And on that net capital gain, you will pay capital gains tax on property, which is at either 28% or 18%, dependent on whether you are a higher rate or a basic rate taxpayer. So, for example, if you bought your property for £100,000 and you sold it for £200,000, there's a gain of £100,000. Now, what you need to consider then are all of the other expenditures and all of the other things that need to be taken into consideration. So in this instance, let's suggest that you own the property jointly with your husband or wife or your civil partner. So we always look at the joint ownership aspect first, because we divide that then by two, assuming you both owned it for the same length of time. We divide the ownership by two. So on that £100,000 gain, the gross gain is £50,000 to each of the owners. Now, why that's important is that there can be different circumstances that apply to each of the owners. So we've got to start with that gross amount of £50,000 each. In this example, we're going to keep it really, really straightforward and assume that both owners were in exactly the same position throughout the relationship and throughout the ownership of this property. Okay, so we've got £50,000 each. Then we take off the principal private residence relief. So for this example, let's suggest that we bought the property 20 years ago and they lived in it together for 10 years before renting it out together. So half of the time that they lived in it, they will have private residence relief. So that automatically halves that gain from £50,000 to £25,000. Now, There's also a little bit to be aware of that whenever you have lived in a property for a certain length of time at all, there's an additional relief, which means that you get the last 9 months before you sold the property as PPR relief as well. But I'm not going to calculate that for this example, as it's going to become too complex. But you do get that additional 9 months. So we've split the gain between two, and then we have halved it again because you had half of the time that you lived in the property. So now we've got £25,000 gain each. Now off that we'll take any capital expenditure that we can. So let's suggest stamp duty, land tax, legal fees on disposal and acquisition, other land registry fees, bits and pieces like that, come to £5,000 each. So that reduces your gain further to £20,000 each. Then additionally, we're going to assume that this property was sold after the 6th of April 2024, which means that unfortunately you only have a capital gains exemption of £3,000 each, which is a real shame, because if it had been a couple of years ago, you'd have had over £12,000 each, which would have reduced that quite dramatically. But we take those £3,000 each off and you're left with a gain of about £17,000. And that's the net gain, and that's the number on which you will pay your capital gains tax. Now let's assume that one of the partners is a higher rate taxpayer and one of the partners is a basic rate taxpayer. So if that's the case, the partner that's a higher rate taxpayer will pay capital gains tax of 28% on that 17,000, which is £4,760 of tax that they'll pay. The other partner, who is paying capital gains at basic rate band, which is 18%, will pay £3,060 of tax on that gain. So hopefully that makes sense. You've got your tax computation all calculated out, you know that there's a gain, and you know that you need to therefore create your digital account with HMRC, submit your computation and your return, pay the tax once you're given the payment reference code and the link, and Bob's your uncle, you're all done. You do have the opportunity, of course, to catch up and make any amends whenever you come to complete your self-assessment tax return at the end of the year, but you cannot claim for anything that took place post-completion statement. So those costs can't be claimed back in that return. I think that covers how to calculate any capital gain on a UK property sale. If you've got any questions, as ever, just drop them in the comments or drop us an email, and we'll always be very happy to help. That's it. Bye for now.